Welcome, class, to a podcast explaining how to complete the exercises given regarding deferred income taxes. So our exercise 1 starts by giving us the income before taxes, $243,000. So that's our starting point. And what we want to do first is recreate what would go on the tax return to get taxable income. And that's what that question asks, is what is taxable income? To get that, we first consider the permanent difference, which is, in this case, municipal interest given in the problem. We subtract that because that would not be taxable, ever taxable, because it's permanent difference. So after you subtract that, you have $223,000. Then you look for the two temporary differences that are given. One is the bad debts. Now, the interesting thing about bad debts is the tax law only allows for a deduction when you write it off, and your income statement is going to record the amount that you estimated as allowance for bad debts during the year. That's what you're going to debit to bad debt expense. So if you look at your T account for the allowance for bad debts, the difference between how much you estimated and how much you wrote off for the year is $8,500, which also happens to be the amount of the allowance on the balance sheet at the end of year 1, or in this case 2015. So that is your difference for year 1. So that goes here, and that's going to be added because your amount that you can do for taxes is lower than what you can do for your income statement. What you have there is a future deductible amount, because in the future, when you actually write those off, you'll be able to deduct them. So future deductible amounts result in tax assets. So we'll make a note of that for later. Bonus depreciation on the asset was given, the asset we bought new was $61,500. So over here, kind of off the side, we do a calculation on how we would do the tax depreciation. First 50% bonus plus makers on the remaining $30,750. Now, makers is calculated by finding the percentage, which in this case, as it's shown over here, is 0.1429. That's the ratio, or the amount we multiply by the remaining after we take off the 50% basis in our property. So that's how you do makers. I'm not interested in going into the entire thing about how to calculate depreciation for tax purposes. We'll just take that as an illustration. We add those together, and our total depreciation for taxes on the tax return is $35,144. For our income statement, it's easy. We just take the $61,500, divide by 7, and then divide by 2 for the half-year convention, and get $43.93. The difference is $30,751. That is how much additional depreciation you're going to deduct for the year 1 on the tax return, giving you taxable income of $200,749. Once you have taxable income, then you can start recording your journal entries. First journal entry we want to do each time is take our taxable income times the tax rate and get a debit and a credit to tax expense and taxes payable. This is the amount that's actually going to be remitted with the tax return. So you take the taxable income, you multiply the tax rate, record it as tax expense and an amount that's going to be paid right away. This tax payable is a current liability. Next, we take each of our temporary differences. What we want to look at is the cumulative difference. Now, in year 1, the cumulative difference and the year 1 difference is the same because nothing else has accumulated. This was the first year of operations. So we take our $8,500, which is our cumulative difference, and the yearly difference. We multiply that by the tax rate, And we already discussed that that is a future deductible amount. So the amount times the tax rate is a deferred tax asset, and we're going to credit always deferred tax expense. So any change to the deferred tax asset or liability is offset by a change to tax expense. Looking at the depreciation, we're going to do the same thing, multiply it by the tax rate, but in this case we have a future taxable amount because you will not be able to deduct that bonus in the future, so you're going to have to pay more taxes later. So your deferred tax liability will be $10,763 or so, and debit tax expense for that same amount. So any change to the deferred tax liability is a change to tax expense. So your tax expense has two components: the current portion, which is how much you're going to pay right here, this payable, and the deferred portion, which is the offset of the two changes in the deferred tax assets and liabilities, 77. Total tax expense of 78,050. So on the income statement, you're going to show income before taxes of 243, tax expense 78,50, and net income of 164,950. So that's the answer to our next question, is calculate net income. And to wrap things up, we need to make a reconciliation of our effective tax rate, which is the amount of tax expense divided by the income before taxes, 78,050 divided by 243. That's 32%. In the United States, the tax rate should be 35%. Statutory rate is 35%. So GAAP tells us we have to explain why that's not the same, why it isn't 35%. And remember, the things that cause changes in the tax rate or effective tax rate are all permanent differences, never temporary differences. So we go back up here, we remember that our permanent difference was municipal interest. That is the different reason why we're 3% different from the statutory rate. So instead of paying 85,050 or having a tax expense of 85,050, if it would have been 35%, it's 78. The difference is on that is 7,000, which could have been calculated by taking the 20,000 permanent difference times 35%.